Welcome to The Explainer. Today, we're going to break down something super important, pulling from Paul Pignataro's fantastic guide. We're talking about how Wall Street actually figures out what a company is worth. All right, to really get a handle on this, let's start with a question investors ask every single day. Take a giant like Walmart, the biggest retailer in the world. Is its stock a good buy right now? I mean, how do you even begin to answer that with any real confidence? Well, it's definitely not about just watching the news or having some kind of gut feeling. Wall Street uses a process called fundamental analysis. It's a structured, methodical way to calculate a company's real intrinsic worth, to figure out if that stock is undervalued, overvalued, or maybe priced just right. So let's actually dive in and see how this all works. To get the full picture, you got to look at a company's value through three different but totally complementary lenses. You can think of it kind of like a detective using different tools to look at the same piece of evidence from all angles. And these are the big three, the absolute pillars of modern valuation. Now, the first two, they figure out value by looking outward, comparing the company to its peers. But that third one, DCF analysis, it calculates value from the inside out, based on the company's own future potential. It's when you combine these outside and inside views that a clear picture really starts to form. So, those first two methods are all about what we call relative value. Comparable analysis, or comps, looks at the public market and asks, okay, what are Walmart's peers trading for right this second? Then you have precedent transactions, which looks back at history and asks, when similar companies were completely bought out, what price was actually paid? And that's a huge difference because those prices often include what's called a takeover premium. But this third lens, this one looks inward. It's not about comparing Walmart to anybody else. Nope, it's about valuing the business based purely on the cash it's expected to spit out in the future. And this laser focus on intrinsic value is exactly why it's considered the most technical, the most fundamental of the three methods. Okay, so you've got these three powerful valuation lenses, but what's feeding them? What data are they actually looking at? Well, the answer is the financial model. It's the engine that an analyst has to meticulously build to drive this entire process. Seriously, that financial model is the engine that drives the whole analysis. Think of it like a super detailed blueprint of the company. It takes all of a company's past financial performance and organizes it in just the right way to let an analyst project what's going to happen in the future. So what the analyst does is they build these financial statements so they all talk to each other. A change in revenue on the income statement has to automatically flow through to the cash flow statement and then update the balance sheet. It's this living, breathing, interconnected model that lets them forecast all the key numbers they need for the valuation. You've probably heard the term EBITDA thrown around all the time, and for good reason. It's a really crucial metric. Why? Because it strips out a lot of the noise from financing decisions and accounting rules. This lets analysts compare the pure operational profitability of different companies on a true apples-to-apples basis. And here's what that looks like in the real world. To make that abstract term feel a little more real, this was Walmart's actual EBITDA from the book's case study. We're talking nearly 35 times $1 billion in core operational profit in just 1 year. That's some serious financial horsepower. And this is really the key here, unlevered free cash flow. Just think of it as the total cash pie the business generates. It's the cash available to all of its investors, both the shareholders who own the company and the debt holders who lent it money. And that is the essential ingredient we need for our intrinsic valuation method, the DCF analysis. Okay, so the analyst builds the financial engine. They run the numbers through those three different valuation lenses. After all that work, how do they bring it all together to actually answer our original question about Walmart? And that right there is the big secret. The magic isn't in any single number that one method spits out, not at all. It's about seeing where the results from all three methods line up, or, just as importantly, where they don't. That's what tells you the real story. This chart is what they call a football field on Wall Street, and you can totally see why. It lays out all the valuation ranges from each method side by side. Just look at it. Each method gives you a different range, but they overlap, right? The DCF and the comms are kind of in the same ballpark, but then look at the precedent transactions. It gives a much higher range, and that's because it's baking in those takeover premiums we talked about. So after all that, why does this super structured, number-heavy process really matter? Why should you care about any of this if you're interested in business or investing? Here's the most important takeaway.
Valuation isn't about hunting for one single correct price. It's about building a disciplined, data-driven framework. It gives you the tools to move beyond pure guesswork and make a rational, logical decision about whether a stock's price seems reasonable based on its fundamentals.
And this brings us to the final and maybe the most crucial point. Even with all of this incredible data, all this analysis, valuation is still both an art and a science. The football field, it gives you a data-driven range of what's reasonable, but that final call to buy, to sell, or to hold, that comes from combining all that quantitative work with qualitative judgment about the company, its leadership, its place in the market. The numbers provide the map, but in the end, the analyst still has to drive.